Welcome to Risk Watch Plus. I'm Dennis Agel.
I'm Ken Agel. Thanks for joining us today.
Each week, our editors at Risk Inbox comb through dozens of websites looking for the top issues in compliance. They curate that content and present it here at Risk Inbox. You can subscribe for free. Each week, we send out a weekly list of the top 5 items. So we've asked our editors to look through the sites and pick the 3 hottest topics from the past week. Let's take a look at the first one. Hot topic number 1, credit reporting requirements in a COVID-19 era. Credit reporting is tricky enough, but there are always new layers of complexity added by the CARES Act. The Federal Reserve has issued some guidance to help explain the basic requirements of the Fair Credit Reporting Act, and then how coverage and reporting are impacted by the CARES Act. It does the same for the Equal Credit Opportunity Act and how it is impacted by the CARES Act. So Ken, with consumer complaints skyrocketing during the pandemic, this seems to be an area where extra attention is warranted.
Yeah, anytime you're talking about consumers and borrowing, you're really coming together as it relates to consumer credit reports. So clearly, it's important for institutions to make sure they're going through the processes to promote compliance, especially now, because we're going to see some impacting events as it relates to consumers and their credit reports. Accuracy is key.
Let's move on to our next hot topic number 2. The Fair Housing Act's disparate impact standard is caught in a crossfire between powerful forces in the industry. Before we get into the latest with what's going on with disparate impact, Ken, perhaps you could briefly explain what disparate impact means, since it seems to be one of the more complex areas of fair lending.
Yeah, when you're talking about fair lending, one of the elements that was created in disparate impact had to do with whether or not an event could be connected to outcome. And so under the disparate impact concepts, the two were connected, that it wasn't necessarily the intention, but it happened by chance. And therefore, by chance was underplay. Was it the intention of an organization to create a differences in treatment, or did it happen because of an unintended but nonetheless impacting event? And that's where this concept came into play. HUD itself has been in the crossfires. They've gone back and forth between the various administrations trying to deal with it, and now it seems to be on kind of a return course. We'll see what's going to happen.
So the disparate impact rule was put forth under the prior administration, and then under the current administration, HUD is proposing to kind of scale it back a little bit and looking for raising the bar for what would qualify as disparate impact. So a plaintiff would have to meet some more strict demands. Now, in light of recent emphasis on discrimination in its various forms, Democrats and fair housing advocates are now saying that this is not the time to change the disparate impact rule. And even some corners of the banking industry are agreeing that now is not that time. Here's this quote from an industry ally, the National Association of Realtors, that says, "Now is not the time to issue a regulation that could hinder further progress towards addressing ongoing systemic racism." Let's move on to hot topic number 3. It's specifically directed at our friends in the credit union space, but has broader applicability to all financial institutions. The NCUA has updated its supervisory priorities in light of the pandemic. They typically release their supervisory priorities twice a year, but this one was accelerated a bit in response to the pandemic. The priorities covered such areas as the CARES Act, various consumer financial protection rules, including the Electronic Fund Transfer Act, Truth in Lending Act, and the Military Lending Act. But at the top of its list was the Bank Secrecy Act, AML. The agency wants to reaffirm that even in a pandemic, institutions are expected to meet their regulatory obligations. The agency expects to publish additional updates to the FFIEC BSA AML examination manual and are offering clarifications to help improve SAR and CTR reporting. So Ken, the agencies have generally been suggesting that in this era of pandemic, there's going to be some relaxation or understanding of certain regulations, but that BSA AML is not one of those areas. They expect full compliance all the time, even in a pandemic, with these rules.
Yeah, it's fascinating to me because obviously these are very unique times. When we're talking about bank Secrecy Act, we're talking often about the currency reporting. And you can see that there's a lot of nuances here. You can't get coins, you have to pay exact change. But nonetheless, when it comes to actual reporting on activities that are potentially suspicious and potentially leading to criminal investigations, it's not like you want to take the gas off the pedal. In fact, I think what they're saying is, we expect you not only to be in full compliance, but be taking action to ensure compliance.
So some extra vigilance might be required.
And it's quite difficult because we all know that doing investigations when you're on a remote situation can be a little more challenging. So, got to find your ways around it. You know, how they gave some leniency areas were often in the ones where you might bend a little bit and not necessarily cut the corners, but at least adjust the corners in order to meet the needs of consumers, or in this case, the members of credit unions. But BSA is different. It requires ongoing vigilance.
And that's a good lead into our compliance spotlight for this week. But first, this message. Welcome back. So much of our nation's financial industry is based on trust. And especially in an era that we're experiencing now, that level of trust is even perhaps more important. So Ken, walk us through how you see trust in the era of BSA AML impacting things for financial institutions.
Yeah, we're going to emphasize today trust, but we're also going to emphasize digital currencies. It's a very fascinating evolution as it relates to how entities or how organizations, countries, even societies place their focus on trust, and then how it applies as it relates to financial transactions. So the S in trust, Dennis, could stand for a lot of things, but in our case, we're going to talk about secrecy. So secrecy, as we all know, doesn't sound like what would be the intent in a regulation that's aimed at reporting. But secrecy has a lot to do with how every entity looks at money. Now, for a lot of us, we want to keep our information private. We don't want people to know what's in our accounts, what our balance sheet looks like. We don't want to know what our medical records look like. We want everything to be secret. But nonetheless, government agencies, when it comes to financial crimes, have to have access to information. So secrecy means oftentimes the retention of information and the presentation of that information when circumstances arise. Now, in the world of digital currencies, there gets to be a few aspects that come into play. When you're talking about secrecy, what it means to one person versus another might mean complete different elements. But generally speaking, most of us want only the minimum amount of information to be provided at all times. The problem with that is the strength of secrecy often comes into play. How an organization retains that information as well as discloses it becomes problematic. Now, where financial institutions deal with secrecy becomes an essential piece. They often hold information that you would want to be kept very private. At the same time, they have a requirement, a responsibility, and just like in our third issue, the NCUA expecting them to be very compliant, they have a requirement to disclose certain information. So where in a financial institution does secrecy cause problems? Now we're getting into a key element as it relates to retaining information and then providing it. But this has to do with the Swiss bank program. Now, when I was a kid, a Swiss bank account sounded like what?
Something you want to aspire to.
Yeah, it was like the absolute thing. Oh, you have a Swiss bank account. The problem with the Swiss bank account, of course, was it was designed to have secrecy. It was insulated from all eyes. And so if you had a Swiss bank account, it basically meant you were probably very wealthy, and it probably meant you were trying to hold financial information away from prying governments. The Swiss bank program was an effort to try to not only crack that, but literally destroy it. And so the idea here was the pressure was being placed on Swiss banks to divulge the information. And you can see case after case after case of those institutions that finally said, mea culpa, I give in, here's the information that you're looking for, and there was an agreement, penalties were assessed, and disclosures were provided. In other words, governments want access to information. All right, let's talk about crypto. Now, Dennis, what word comes to mind, or what concept comes to mind when we say crypto?
Perhaps crypts?
Crypts, yes. You think about something that's buried, something that's hidden, and something that you can't get access to. It sounds a lot like a Swiss bank account in many respects, right?
The modern Swiss bank account.
It's a modern Swiss bank account. But when we're talking about cryptocurrency, we're talking about a digital asset that's designed to work as a medium of exchange, much like money. Much like when we make any medium of exchange, we're transferring something of value for something that we perceive of value. It uses strong cryptography to secure financial transactions, controls the creation of additional units, and it verifies the transfer of assets. So a lot of this has to do with what you would expect currency to do. Cryptocurrencies are a kind of alternative virtual currency, and cryptocurrencies are decentralized. Now, I bet you probably wonder what this concept of decentralized has to do versus centralized.
Yeah, perhaps defining who it is in charge of regulating this aspect.
So cryptocurrencies are a kind of alternative virtual currency, and cryptocurrencies use decentralized control versus centralized control. Of course, the Federal Reserve would be a form of centralized control, where they are tracking funds. Decentralized means there's no government involved, there's no central banking system. In fact, it's just the opposite. It's designed to not have that. Now, we've all heard the term Bitcoin. Bitcoin was first released as open source software in 2009. It's generally considered the first decentralized cryptocurrency. Now, since it's released, more than 5,000 altcoins or variants of Bitcoins have been created. I don't think many people have read this document. It's worth reading. It's Satoshi Nakamoto. He's an unknown individual, but he wrote the white paper that is a known must-read as it relates to cryptocurrency. So you can forget J.K. Rowling. I mean, she's great and everything. But Nakamoto, if you want to understand the concepts, this document helps to bridge those. It promoted things such as redefining a transaction and the use of the hash and the blockchain, terms that we might have heard about, but this document tries to put it together and get us to understand key aspects of it. Of course, a digital wallet is an electronic device designed to accomplish the use of cryptocurrencies. It's including things such as a computer or a smartphone to purchase something at a store. A lot of us maintain a form of digital wallet. I happen to have one in my pocket right here, Dennis.
Well, it looks like a cell phone to me.
It does look like a cell phone. It uses NFC, or near field communication, where I have the ability to put it next to something and accomplish that goal. It is not the same as cryptocurrency per se, but it utilizes a lot of technology as it relates to the principle of exchange. I can exchange and purchase something with this, just like theoretically I could purchase something with cryptocurrency. Now, cryptocurrency wallets, we're getting into another realm. Here, for most cryptocurrencies, the cryptocurrency is a decentralized, stored, and maintained in a publicly available ledger called the blockchain. Every piece of cryptocurrency has a private key. With the private key, it is possible to digitally sign a transaction and write it in the public ledger, therefore facilitating the potential for spending the associated cryptocurrency. So when we're talking about cryptocurrency wallets, we're talking about the ability to make a transaction. Now, do you think you can go buy a soda with your cryptocurrency?
Might be a little complicated and take a little while, but perhaps.
Well, that might be the goal. Facilitating transactions is the idea behind almost all currencies. Now, I want to take you back to an era when it relates to things like the Yap. Now, Dennis, you heard of the Yap before, right?
I Must confess I do not recall that term.
Well, I was a proponent of studying the Yap in the 4th grade. Now, there's an island in the South Pacific called Yap.
I did not know that either.
It's very small.
Are you making this all up?
No, this is all real.
All right.
And in Yap, they found the need to have some type of currency. And so they came up with the Yap stone. What did it look like? Well, it was rather large. It might weigh several hundred pounds. And it was made out of limestone or some kind of stone. And they would put it on their house, and there it sat. Too heavy to move, but it represented value. Now, they found in Yap, just like all of us find, the need to have some kind of mechanism in order to accomplish the transfer of wealth. When we think about cryptocurrencies, it's not that dissimilar from all other currencies, except for it has a new spin. Most individuals are carrying some type of currency on their person. The amount of currency that you have is generally controlled by a centralized banking and an economic system. We talked about M1, or we talk about M2 or M3. Those are controls. In the US, the control is established by the Federal Reserve, and they also control the printing units of fiat money or demand additions to the digital banking ledgers. That fiat money printing handles through the Treasury, through the mints in the US, and we create more revenue, more money into the system. In a decentralized cryptocurrency world, governments cannot produce new units. And as far as we know, they do not back or guarantee the cryptocurrency, although that's starting to blur slightly. So the idea here is that within the cryptocurrency system, the safety, integrity, and balance of the ledgers is maintained by a community of mutually distrustful parties referred to as miners. They use their computers to help validate and timestamp transactions, adding them to the ledger in an effort to maintain a time-stamping scheme. Essentially, they create the tracking mechanism that is utilized in order to establish the validity of the system. So within the cryptocurrency, the integrity is based on the strength of the blockchain. It's a continuously growing list of records called blocks, and they're added together using the cryptography. Each block contains a hash pointer to a previous link, and on, until finally we have a logical transaction that can be identified. Here, let's take a look at how that might look in a very simplistic way. Now here you could see the block and the blockchain. You could see the hashes working in it. The idea here, as part of Nakamoto's guidance, was that there would be no one individual that would control it all, but rather multiple individuals. And of course, it would be outside of any government's control. So how do cryptocurrencies fail? Like real currency, cryptocurrencies have been the subject of counterfeiting. Have you ever had a counterfeit $20 bill in your lifetime?
You know, I can't say that I have.
The problem with cryptocurrencies is there, of course, is the principles that come into play that most people who happen to be trying to create the scheme could also be trying to break the scheme. Double spending is one example. It's a scheme in which the same digital token can be spent more than once, as if the $20 I gave to you, I could somehow mysteriously give it to two people at the same time, dividing it into two. That type of double spending creates problems. It devalues the currency, and it creates the principle that we talked about at the start of this particular effort called trust. Fundamental cryptographic techniques to prevent double spending while preserving anonymity in a transaction are blind signatures, and particularly in offline systems, secret splitting. Double spending attacks have occurred, such as the 51% attack that impacted Bitcoin Gold, not Bitcoin, then at that time the 26th largest currency. So this principle of blind signature is a form of digital signature where the content of a message is disguised or blinded before it is signed. Typically, the signer and the message author are different parties, each of them having like half of the equation, neither of them having all the equation, and therefore it maintains an element of security. In the blind signature world, you might think of it as the physical act of a voter enclosing a completed anonymous ballot in a special carbon paper lined envelope that has the voter's credentials pre-printed on the outside. An official verifies the credentials, signs the envelope, thereby transferring his signature to the ballot inside via the carbon paper. Once inside, the package is given back to the voter, who transfers the now signed ballot to a new unmarked normal envelope. Thus, the signer does not view the message content, but a third party can later verify the signature and know that the signature is valid within the limitations of the underlying signature scheme. So the lure of cryptocurrency is often the potential privacy offered, like the Swiss bank account. All the Bitcoin transactions are public, therefore the transactions can easily be traced on the blockchain, which can potentially compromise a user's privacy, although a pseudonym is often used during the transaction. To address this problem, a third-party coin mixing service can be used to obscure the trail of Bitcoin transactions. Of course, now we're asking some other individual that to be dependent on the trustworthiness of the coin mixing service operator. Like an escrow service, we often have to have confidence in a third party when we're doing a transaction, like buying a home, for example. But in this particular case, it becomes very complicated, and you can start to see where challenges have arisen. The efforts to promote anonymity have expanded and are generally based on cryptographic operations that frequently involve concepts related to secret sharing or splitting. Now, secret sharing, it's a method that's designed to distribute a secret amongst various participants, all of them allocated with a share of the secret, something akin to what we talked about before, but now when they come together, the transaction itself has value. Individual shares are themselves of no value. So when we think about the Yap coin, or we think about any coin, really it comes down to trust. Do you have confidence within the item? Digital wallets still require that the owner keep in mind that the person who is supposed to have access to the private keys, the copy of the key, is potentially given access to the cryptocurrency. Similar to a financial institution. You probably have your money in some financial institution.
Right.
Have you ever had a safety deposit box?
I think I have.
So when you go to access your safety deposit box, you've got your key, right?
One key.
And who has the other key?
The bank vault person.
The bank vault person. The idea there is you both go in, turn your key, you both get access. That way you're confident that you cannot gain access without them, and they cannot get access without you. Under most circumstances, that is true. The idea is you've given confidence to that institution. So money is about trust. Anybody who thinks otherwise is probably fooling themselves. For example, Mt. Gox, the exchange, lost most of their clients' Bitcoins due to an error that undermined the confidence within the industry. Of course, efforts to overcome confidence issues have been ongoing, but it's still about who do you trust. If we go back to Nakamoto, I think there's potentially a key point that was missed in his document, something that he might not have thought about. Let's take a look at a couple of key sections. Privacy, anonymity, secrecy pursued while keeping transactions functional. Now I ask the question, what is central to BSA, AML, and CTF? It was so essential that they had to add a fifth column, beneficial ownership. The fifth column here is designed that we were missing information. Much like the Swiss bank program, the idea was we want to know who's behind the curtain. We're not interested in secrecy to the point that we can't gain information. And so in this particular case, perhaps the most important term in BSA over the last 20 years is this term, know. Know your customer, know your member, know your transaction. When we talk about knowledge in BSA, we're talking about access to information. And so ultimately, when it comes to digital currencies, their main challenge is the need to know and the desire to hide. That's always going to be at play when it comes to currency. And one of the reasons why digital is embraced by so many is it forms a perfect trail for information. And therefore we love it. We don't have to get a receipt. We don't have to deal with paper. A lot of us don't want to deal with paper, but we still want to know that the transaction was as designed. The problem with currency, of course, if I give you the $20 bill, now you have it. There's no record of that per se, unless you require me to sign something. And so in the world of criminal activity, in the world of everything associated with it, it's designed to have this element of secrecy, which is why cash is still king. But cryptocurrency is this hybrid between the two. So let's take a look at the regulatory take on digital currencies. There are many ways they could have addressed and approached it, but probably the smartest way was not to focus on the end user, but rather to focus on entities that would deal with digital currencies. And so FinCEN placed Bitcoin and all other cryptocurrency-like tokens generally under the definition of convertible virtual currency, which is as follows. Any virtual currency that either has an equivalent value in real currency or acts as a substitute for real currency. That's the intent as it relates to Nakamoto's guidance on Bitcoin and other digital currencies. FinCEN also said this about an administrator of cryptocurrency. They're defined as a person engaged as a business in issuing, putting into circulation, a virtual currency and who has the authority to redeem, to withdraw from circulation such virtual currency. Here you must both issue and redeem currency. So it's not enough that you be a user, you have to both issue and redeem. You have to be in the middle of the activity. This primarily applies to centralized networks where parties keep records of transactions on the network and may redeem the currency as well as issue it. So now the cryptocurrency exchangers come into play. An exchanger is a person engaged as a business in the exchange of virtual currency for real currency, funds, or other virtual currency. And therefore, they are an exchanger that accepts and transmits a convertible virtual currency or buys or sells convertible virtual currency for any reason. They are therefore a money transmitter under FinCEN's regulations. An extremely wise use of definition to make something apply, and therefore once it becomes applicable, you have the ability to enforce on those entities. Now keep in mind, when we talk about secrecy, we're looking at the desire for governments to have access to information. That was kind of the fundamental point as it relates to BSA. So in 2015, FinCEN reached a landmark settlement agreement with Ripple Labs as a digital currency provider and fined Ripple for violating several requirements of BSA. This is what they said. Acting as a money services business, MSB, and selling its virtual currency known as XRP without registering with the FinCEN and by failing to implement and maintain an adequate AML program designed to protect its products from use by money launderers or terrorist financiers. So here we had FinCEN saying, look, you can be engaged in this business, but you have to register. And once you've registered, now you have to comply with BSA and have an AML program. And we could go back to the fundamental element of BSA, and that is know. So to know your customer is the exact opposite of what is wanted under cryptocurrency. They don't want to be known. In fact, that's what the whole goal is. But BSA wants you to know. So FinCEN further stated, virtual currency exchangers must bring products to market that comply with AML laws. Former FinCEN Director Jennifer Sasky-Calvary said this, innovation is laudable, but only as long as it does not unreasonably expose our financial system to tech-smart criminals eager to abuse the latest and most complex products. And that is really at the heart of what we're talking about. Now, Alan Greenspan, former chair of the Fed, said a lot of things about Bitcoin. He said this, I would use the analogy of the continental currency. Continental currency in 1775 was issued with no backing, and it sold at par in the marketplace for quite a while until they started to build up more and more printing of continentals. Human nature is such that if you get something such as Bitcoin, you think there is some value there, whether there is or there isn't. But that's the same thing as the continental. Greenbacks in the Civil War, all those currencies which didn't have any backing. So when we go back to the YAP only had value because the people said it had value. You could transact something fairly significant. You didn't buy a soda on Yap with your Yap coin, but you did something big like buy a home or engage in some other major activity.
Something worth moving the rock for.
Something worth moving the rock. Maybe your crop failed and you needed to get bailed out. But nonetheless, when we think about Bitcoin and we think about cryptocurrency, who is going to back it? Is there anybody behind it? But before we dismiss Bitcoin and blockchain and cryptocurrencies, let's take a look at this slide. The top 10 companies by the number of blockchain patent filings. Now, the principles behind the technology may not apply. Cryptocurrencies may not ever be the end-all be-all, but blockchain technology, the use of that, is important. It has value. So we all recognize that many of these household names see the value in technology. None of us want our transactions to be compromised, and therefore blockchain offers something of value. It may not be in the form of cryptocurrency, but it's still something worth following. So in the effort to find trust within the world of cryptocurrencies, digital wallets, this type of statement comes into play. It was noted that the following: the use of virtual currencies presents new risks and challenges from the perspective of combating money laundering, and that member states should ensure that those risks are addressed appropriately. To date, most governments do not recognize cryptocurrencies. There are a few, but you'd also know that those countries that do recognize it typically have need to recognize it. In reality, when we're talking about cryptocurrency, we're talking about the need to bring it into the mainstream, and that might work directly against it. This is what FATF said in October 2018 on virtual assets. It recommended that jurisdictions ensure that virtual asset service providers are licensed or registered, monitored by the government, subject to AML regulations, including due diligence, reporting, record keeping, and recommended that jurisdictions assess and understand the risks associated with virtual assets and identify effective systems to conduct risk-based monitoring or supervision of virtual asset service providers. That particular effort is somewhat counterintuitive to cryptocurrencies, and therefore we have right now a clash between the two. So how is it going to work? FATF itself gave new sweeping definitions designed to include, much like we talked about, those entities that deal with cryptocurrency, and they have to become a registered entity. The other thing about it is the definitions themselves mean that those that are involved in that will have to go through additional steps. That's going to be significant. And so we have to ask ourselves some questions. Can digital currencies achieve fiat currency? Can it become something that we value within a country? Janet Yellen, former chair of the Federal Reserve, cited weaknesses on this emerging technology back then. She said this: "It's long been thought that for something to be of useful currency, it needs to be a stable source of value, and Bitcoin is anything but." Then she added this: "It's not used for a lot of transactions, it's not a stable source of value, and it's not an efficient means of processing payments. It's very slow in handling payments. It has difficulty because of its very decentralized nature." And then she pointed something inherent not considered in the original white paper on cryptocurrencies. The Fed doesn't really play any regulatory role with respect to Bitcoin, other than assuring that banking organizations that we do supervise are attentive, that they are appropriately managing any interactions they have with participants in that market, and appropriately monitoring anti-money laundering, Bank Secrecy Act responsibilities that they have. Ultimately, the thing that keeps cash alive, even during times such as now, is that it offers two key elements that cryptocurrencies appear to currently lack. Cash has the strength of regulations needed to ensure some element of monitoring, and has the core element that fiat currency provides: confidence and backing. When we think about it, we're talking about trust. Now, a lot of people recognize that symbol there. You probably recognize that as well.
Greenback.
Yeah, and it's interesting. A lot of people don't recognize or know that the greenback, the dollar symbol, actually originally had a U in the middle of it. Those two lines were actually connected at the bottom. And therefore, the US dollar symbol eventually evolved. And at one point, those two lines became one. And that's the symbol we have today. But at its source, it is something that the world has trust in. How long they'll have trust, we don't know. But right now, that trust is what keeps the US currency as the global currency of choice. And without that trust, of course, you have nothing. So today's Compliance Spotlight isn't necessarily to give you a full primer on digital currencies or crypto wallets or Bitcoin, but it's designed to maintain awareness of trust. Trust is essential to compliance, and it's important that organizations, to maintain that trust, that they align their programs appropriately, and that's really essential to all activities as it relates to the financial world, and I think we can always keep that in mind.
Thanks, Ken. Interesting stuff, and we appreciate the background for maintaining trust within our financial institutions. I'm Dennis Agel for Ken Agel. Thanks for watching RiskWatch. You can get a certificate of completion by sending an email to RiskWatchPlus@advisex.com.